Hey, this is Sasha. Thanks for joining me here on another episode of Let's Talk Stocks, episode number 123. Today we're going to be talking about euphoria and emotions when trading. I'll just give you some insights here briefly on the market, what I see as far as market conditions, and more or less an important evaluation of yourself of evaluating and looking at market euphoria. And of course, before we get started, keep in mind all of this is for educational purposes only. So if we take a quick brief look at the overall markets here, we just, let's see here, pull up the TC 2000. And we just look at what's going on, what's happening here in the markets. Let's just start with the SPY on the spiders. You can see that here with the volume, we did have some volume picking up right here, which is typically a good sign. When you see volume picking up like this, it's usually a positive sign for markets. Now, the only thing about this is you always have to look at it in context as how far stretched are we from, let's say, a moving average or an average. Now, on the daily, we're looking quite stretched. If you look at the weekly as well, you can see right here the distance between this moving average, and I have it here in purple. Let me make it a little bit more noticeable for you. So here you can see how much further stretched we are. And remember, markets are like a rubber band. The more they stretch one way, the more they'll snap back. It doesn't matter if it's going to the upside. It doesn't matter if it's going to the downside. If it's breaking hard to the downside, very hard, you'll probably see a snap back to the upside. If you see it breaking out to the upside very strong, you'll probably see the counter trend snap to the other direction, also very strong. So when you start looking at all these things, you can't get too caught up in the emotions when it comes to the markets. And the previous week, some people mentioned that, hey, they like watching me read things and mention things. And I'll just share with you some of the things here that I was looking at and just some of the things I've shared. It's very interesting to me when I look at news reports and things like that, because there are a lot of people, they trade based off of their emotions. So I kind of mentioned here, February 15th, VIX is going up while the market is unchanged. Big boys know something. Be cautious. So when you start seeing the VIX creep in, it's a way for markets to push things higher, the smart money to push things higher and see if they can suck more people in, while they're, on the other hand, getting and buying protection. Now, they can't hide their full position, so the VIX is an interesting indicator to look at. So when I saw the VIX here on February 15th heading a little bit higher, I mentioned that, okay, it's heading higher, but why is the market also heading higher? Then, you look at these sayings that come out, NASDAQ and longest record streak since the dot-com bubble. Also makes you think, well, if we're in the longest streak since the dot-com bubble, well, what happened after that longest streak? A bubble, right? Which is also very ironic for what happened here, where we just talked about the bubble just the other week. So, and then finally, the other indicator I was looking at and pointed out, powerful market, but Bollinger Bands on the SPX is stretching. So again, if you look at this, you can see I posted this chart. It's way beyond. It's one thing. Here's the thing about Bollinger Bands. It's one thing to see Bollinger Bands go beyond it on the downside because you have fear in the market and much more on emotional trading. It's another thing to see it to the upside. And I've seen this in the past, but I haven't seen it in the past with such a terrible administration that has things in chaos. Okay, so we'll see if the regulations actually come through, but nothing's even really happened. And of course, market trades on the rumor. So you buy the rumor and you sell the news, right? So think about that concept. They're buying the rumor, but when the news comes out, it's probably not going to be as good. Like the immigration ban, it was this big thing, and then what happened? Nothing happened, right? So in either case, it wasn't as good as projected. So in either case, you also have to remember we're going into a market closed on February 20th for holidays. So people will want to take some profits. Now, this doesn't mean the market's going to crash. That's not what I'm saying. I'm just saying that watch out when things become stretched on the markets and you start looking at, let's say, the SPX or the composites, and you start seeing, and we'll pull up the Bollinger Bands here for you. When you start seeing these things, remember, Bollinger Bands try to contain things. And it's very rare that you see things going outside of the Bollinger Bands, and you do sometimes here. And of course, it's a relative indicator, so you compare it in the past relative to, let's say, the past time of going outside of them. But you usually don't see it at this extreme where the Bollinger Bands open up and the VIX is also spreading. So this kind of, all these things working together as the VIX starts popping, but market's still going higher, it starts to give you some clues. And again, I'm not saying you can't bump it or push it into higher prices. What I'm saying is that, remember, when other people are buying and they're euphoric, you should be selling. And when other people are selling in a big way, let's say down here, just like we get Bollinger Bands outside of the range, you should be a buyer at this, because remember, we get that snapback, right? The rubber band effect. So in either case, that's kind of the big thing I want you to think about. And if you go into the weekly on the S&P, you can also see that. So we have the daily, the weekly, but more or less the monthly. Okay, the monthly is a big thing that you watch. Where on the month have you seen it go that much out? Okay, so looking back, it's very rare. I mean, it got in here, what do we have, in 2013 a little bit, but again, big streak. So to me, it also means be very cautious because you can get a snapback, maybe 23.10 without a problem. Again, not saying it will happen, but the statistical chance, the probability is markets trade on these emotions. And that's what I want to talk to you about today is we'll look at some emotions and more or less how people trade when they're looking at emotions. So that's kind of the quick little lesson that I want to share with you, and it's just going to be short here. So we'll talk about when putting on decisions and in the market. I like to look at this also in being productive. It's a good little diagram to think about and look at. So here we kind of have two extremes. Up here we have your higher self. Okay, and this is your lower self. So you could look at this in making decisions or making processes to decide to work out. So when you're feeling in your lower self, right, you feel crummy and you're, let's just say, unhappy over here, okay, you probably don't want to work out. So that's kind of a decision in your lower self you probably don't want to work out. Whereas if you're feeling happy, you probably want to work out. Oh, I feel good, I'm losing weight, whatever it is. You feel good. And this is how the markets behave. They basically work on the same premise. Now, in here, this is where you are content or even. Okay, so I'll just say even for shortening purposes. Okay, so this is when you are content or even when you're overall, between the higher self and the lower self. So in these kinds of markets, what's going to happen internally, and I'm talking about inside of you, think about it in your stomach, in your heart, in your brain. This is what's going on, is it's whipping things around. You'll probably have these roller coaster emotions a bit. And this depends on how high. For some people, they're more volatile. They'll have more volatile emotions. For you, you might have a lower wave pattern. Okay, so if it helps you to visualize this, this is why I do visuals. So looking at it, find where your wave pattern is. Okay, so you'll probably have a wave pattern. Now, when the markets get into, let's just say, very euphoric or emotional state, they actually go and almost at this higher point, they almost go beyond this point. And this is where euphoria happens. Okay, so this is where our euphoria is at. Okay, so that's our market euphoria. Now, at this point or this juncture, there's kind of two main things that could happen, obviously. Now, when you're in euphoria state, you think and assume, because the market's been heading higher, and let's just say you're long only position. So let's just say you're a long trader and the market's heading higher and you got in it, you assume we're going to continue moving higher. So that's your assumption. But in reality, what ends up happening is because you're so far stretched, just like the market's a rubber band, this is what happens, is it rolls back down and then you get away from that higher self, go into a lower state. Maybe you'll get back to even, or even it'll drop even more so because now you get crushed. It'll go even further lower since you were at a higher state, and moving down just a little bit drops you much faster. Okay, because you're at this juncture in this euphoria state where you had one assumption, but now something completely different offset this. And That really is troubling for many people and many traders. So it's really important that you watch where you're at, because this is like a rubber band. It stretches you one way or the other. And if your market is stretched one way, more than likely it's going to pull back. So that's why when everybody's at their most euphoric state, when they're at their happy state, that's why you're the person selling. Okay, when they're buying, you're a seller. And the same thing works in reverse, right? When a market, let's just say we're down here, this is where you're at a panic state. Again, it's a fear state, right? This is extreme greed, if you want to talk about the market. This is extreme fear. Okay, and again, you have two crossroads. Many people think, okay, it's going to continue going down, but if you're logical and you're thinking about your decision process, the reality is because we're so far stretched, you're more than likely going to get that snap back, okay? And this is, again, depending on where you're at. So you have to be more clear at understanding the location of you personally, whether you're in your lower self or your higher self, relative to the market as well. So I could draw another diagram, and you could do this exact diagram and look at it at the market. How far stretched is it to the upside or the downside? And that's kind of what Bollinger Bands ultimately do, right? So what they do right here is they look at how far stretched things are. And in fact, if you look at it right now, we're down about 8-9 points. They'll probably try to do a little bounce in there because, again, it's just one day. It's still one day, and one day doesn't make a trend. So they'll probably make a try to get this to bounce here. Let's see if I could zoom in a little bit right there. So what they'll do is they'll run it down, and again, we're getting far extended from this Bollinger Band, even on the 10-minute, but they'll probably try to bounce it a little bit, and then we'll see if it rolls back over on Friday. Because that's where the danger may lie, is that Friday where you really get some massive selling action before the long weekend. So again, we're looking at it and we're stretched right here, and that's the same exact thing that happens in this kind of diagram. If you look at it just the market, again, when you're stretched, it'll more than likely bounce. When you're stretched over here, more than likely pull back, and always try to get to that average. That's why they use moving averages. But you have to also look at this yourself as, where are you personally, when it comes to the market? Are you in that unhappy state, okay, or are you in this happy state? And if you're in the very happy state and the market is extremely high, that is dangerous, very, very dangerous. Okay, so again, let me reemphasize this. In general, when you look at this and you have a higher self, okay, and you have a lower self, but then you also have market high and market low, okay, and you start looking at this, okay, so let's just use purple right here. This is the market, and we'll use red as you. Okay, so if the market right here has been moving, whipping around to the upside, and the market's over here, and you are also over here, that's dangerous. In fact, when the market's up here, you should be, somewhere over in this content level. It's always better to be even on your emotions, okay? Very nice, very even, okay? But if the market's really high, and then your emotions are also way up here, that's really dangerous, because now you're assuming this market's going to head higher when in fact it's going to snap back. And the same thing on the other side, okay? So if the market's heading, let's say, lower over here, and it's way beyond this price point, and then you also are very depressed, then you sell. This is where the selling happens. You sell out of your position and you take your loss right before you get that bounce back. So again, it's better to be a little more calm right there, or even be a little more greedy. Say, hey, I'm going to put on this position because of that snapback. So I hope that really makes sense, because ultimately that's what you want to do, is you want to look at your emotions, how far stretched they are, just as much as you want to look at the market at how far stretched they are. Because if you have too much emotions in the marketplace and they're too euphoric and the market's euphoric, that's where most people lose out. So if you look at yourself and you see, hey, am I losing because I'm trading too emotionally? This is one of the reasons. It could be one of the reasons to look at. It's because of that greed and fear factor. So ultimately, I hope this helps you, taking a look at things maybe on a diagram. Some people are more visual, giving you some insights. Again, if you look at this market, we're quite stretched. It doesn't mean you can't go higher. It just means it's nice to get a little pullback. If you get this market and you get it to pull back right here and then bounce, that ultimately is a much better recipe, or it's a much better setup, or even a slight little pullback, because it allows digestion, just even slightly, it allows digestion. But if you continue to keep powering higher, just like in Tulip Mania, what we covered in the previous episodes on the stock market bubble, you will see a major pullback. The further stretched it gets, the more major the pullback. And you can see right now, as I look at this S&P, you can see we're down about 10 points. Again, looking on my screen, because this is 15 minutes behind, here we're actually 6.56 points down. So again, they're trying to bring it back up a little bit, try to suck in some more people, and we'll see what happens. But ultimately, you need to look at the bigger picture, at how far stretched you are, and then look inside of you. Are you being too emotional, too euphoric, meaning the market can never go down? And even though we had this great run up, take your money. This business is about taking money off the table. If you don't learn that, if you don't learn to reduce your risk when conditions in a 25-year period or in such a major euphoria state are set up, and that you had this one chance right there where things were great, and you don't take your money, the market's going to take it for you. That's what usually happens to most people. They get sucked into this, their emotions catch up to them, they get greedy, then they start holding on to positions, and then you'll see them give back all their profits. Let's just say they were up $1,000, now they're back down to no profits. They're back to their $10,000 account or whatever account they started with. And then some people even continue to hold, praying and hoping that things continue to go up because it was so good in the past. They ride off of that past euphoria when the market continues selling, and then they get into the denial, okay? And once they get into this denial state, this market continues to go down, and then they sell it at a loss. It might be a negative, they lose another $5,000. So their $10,000 account becomes $5,000 when in fact they were way up here in the marketplace, and they would have been out with a couple $1,000s in profit. So that's the thing. You need to be really careful and cautious about these kinds of markets, that when people are constantly pumping it to you, know the bigger picture. Have your plan in mind. Think about what it is that you're doing and what's on the future for you, because everybody's plan is going to be different. What's your risk tolerance? Look at it that way. Set up yourself a plan, execute that plan, but also understand how your emotions are playing the game for you. So if you can block those things out, if you can be aware of those things and counterbalance those things, then it'll allow you to be a little bit better trader without as much emotion. So I hope this was helpful. Really, thank you so much for joining me today. Hope you enjoyed this video. By all means, check out some of the other videos that I have right here. If you want to get on the newsletter list, click the button right here. That's where I release some other news, activities, free training material, and even discounts to some of my products and courses. Thanks again, and remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.